Hey traders, this is Ron Haydat, Market Tamer. Happy Sunday. Hope you guys are having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. We'll kick off here on a daily chart of the diamonds, the DIA. You can see the sell-off. You can see the late December, Christmas Eve bottom, and then we've gone straight up. Very impressive, but now we're starting to roll over. Now, volume has not picked up a whole lot yet. If you look at these red bars, those are down days. Black bars are up days. The reds aren't that high yet, but as we can see, sometimes they can get higher after the downtrends are already in place for a bit. If the volume starts to pick up, that's probably going to accelerate things. I would say on the diamonds right now, the target's going to be the 50-day and the 200-day. And they're coming in, the 50-day right now is 247, and the 200-day is about 249. It's about a 200-point Dow spread, or $2. If we cut below both of these, that will not be good news. We could consider it to be a big inverted head and shoulders pattern. Left shoulder over here, take your pick, head down here, and maybe what's going to form now will be the beginnings of a right shoulder. We're getting ahead of ourselves at that point. Got to wait and see, because if a right shoulder does develop symmetrically, it's already going to be below these moving averages, which would give the bears the edge. I'm just pointing that out, something to watch for. As of right now, I think all eyes should be on whatever is going to be the lower of these two moving averages. Right now, that's 249 at the 200 and 247 at the 50. That's where I want to put alerts. If I go to the spiders, we zoom in here. Again, you can see the rollover volume is not excessive. I mean, you think back to October, like I showed you on the Dow, the initial crack was big volume. Then we consolidated, and then the volume returned during the December massacre, if you will. We don't have that yet. So that means what's ever happened so far is very calm. What would happen if volume picked up? Probably something like this, just guessing. Support, we're already at the 200-day, and interestingly enough, we bounced at that institutional moving average, not a surprise. I want to watch the 50-day for the bigger number. We get below there, we've lost both institutional moving averages, and the target goes all the way back down here. Not saying we're going to get there, but that would be the target. Now, we could use fibs and go from here to here and see where some support would tie in, but I prefer to just make it simple or keep it simple right now. If we do break down through support at that point, I can bring in the fibs, Fibonacci's. Here are the cues. Let's go ahead and zoom in. I'm going to get rid of this downtrending channel now that it's well past. You can see in January, once we got above the 50-day in orange, we were back testing it, even back testing the red line, which is our 20-day EMA, and now we're starting to crack. We're below the 20-day, below the 200-day. Again, I'd watch the 50-day. That's the last line standing. We get below 165. I could make an argument for a little bit of support here at 160, but otherwise it's right back down here. If I do the IWM, Russell 2000, it's been the weakest. It's already spent 3 straight days below its 20-day. Volume not excessive yet. Watch the 50-day below there. Boom, right back down to the December lows. See a theme with all of these. Here are your mid caps. Same thing, 3 straight days. Watch the 50-day. We get below 50. Day at 331 is where it stands right now. That's where I'd want to put an alert to make sure I don't miss it. Life can get busy below there. Target down here. So everything's sort of falling into place here as the markets are rolling over a little bit. If I bring in the VIX, we were down on Friday, came way off the highs. The VIX has not broken out yet. I would probably put an alert on the VIX maybe around, there's no specific number. How about 19? We get above 19, I want to be aware. These are all on closing basis. It's intraday, I don't really care that much. But you know what I want to do? Just to give you guys some perspective, let's go do a 2-year and make it a weekly. Now every candle is 1 week's worth of data. The weeklies are still fine. The 270 area is going to be important because that's where the 20 and the 50 period moving averages hit. If I do the diamonds, they're still well above. Now I know what you could say on the diamonds, oh my goodness, here's a top, a double top. Every time a stock goes up to a previous high, it looks like a double top. But there will be lots of people that will come out and say, oh my God, the world's going to end, right? If we start closing below these moving averages, then the double top has now been confirmed for the time being. Just keep that in mind. The Qs, still above the moving averages. The Russell, almost below moving averages, just a little bit more. and the MDY. Almost below all the move. When I say all, the ones that are clustered together, the last one standing is the 20 period. Just heads up on that. Still, the dailies are rolling over, the weeklies are holding. Since we're on the weeklies, let's take a look at the banks. XLF really couldn't get through the 50 period on the weekly. Take a look at the SMH, so do banks and semis. They got back up into this big overhead supply area. So there's, to me, the fact that the SMH is running into resistance on the weekly basis is no shock. Look at all this overhead supply. It's nearly 2/3, 3/4 of a year. It is 3/4 of a year. Let's go back to a daily now. 1 year. Zoom in. There are your semis. They T-boned off the 200-day moving average. We break that, we go to the 50, we break that, and that's where things start looking even more bearish. So short term, if you want to use the semis as a guide, they're below the 5 in blue, the 20 in red. Bears have the edge in the 5 and the 20 period outlooks. Remember, those are trading days, not weeks, not calendar weeks. You break the 200 period, that's also more bad news. So far, the semis you cannot see are short-term bullish at all, and they are teetering, starting to go bearish here on the dailies. Transports. Here's the ETF, the IYT. I was reading some articles, there's been some talk about, oh my goodness, the trannies haven't done this since blah, 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 and the last time that happened. I get all that. They always love to parade those headlines. Sometimes they're true, sometimes they're not. Personally, I don't care. I trade what I see, not what I hear and what I read. If we lose the 50-day, that is bearish. I don't care what headline they want to run out there. They'll try to find something, but it's all about clickbait. We break the 50-day, then the target, all the way back down here. Now, if I go $TRAN, this is more commonly used for the trannies. We get below the 50-day here. There's a gap at now around 97.50, and then it's a gap fill down here. So just heads up if you're also watching $TRAN. I do want to say thanks for the kind comments about the videos. I do appreciate it. I enjoy doing them, and I'm glad you guys find them helpful. There was one specific question, and if I bring back the SPY, and you look at there, look at the purple and the orange. And one question I got asked is, why are the 50 and the 200 so important? The bottom line is, I don't consider them important just based on my own. It's what I've been taught, what I've learned, what I've read. If you go to a technical analysis class, this is what the institutions are aware of. Some people like, 9-day EMAs, 13 days, 33 days. Some like SMAs over MAs. Everybody has their own little thing, and that's fine. What I would encourage you to do in practice and on paper is sometimes you'll find, a 55-day works better than anything else. It just depends who's trading that stock and what they're watching. And if you stumble across it, it can be really valuable. If I think back to, 10 years ago or so, on BlackBerry, on RIM, when the ticker symbol was RAMM, there was a period of time that the 100-day MA, 100 MA on a daily chart, if it ever hit that, if my recollection is correct, it was like money in the bank. It hit it, it bounced, and it ripped. You literally could put a buy in right when it hit that line and a tight stop, and it was amazing. And then one day it stopped working. And that'll happen to anything. So there's no one thing that works on everything. That'll never happen. But why I use the 50s and the 200s as a moving average, it's too much data to use an EMA. On an MA, every day gets the same weighting, and there's so much data it doesn't matter. But I won't use an EMA because that's exponential. That gives the most heaviest weighting to the most current day. That's why EMAs are used, in my opinion, on the 5s and the 20s. Much more shorter term. What happened if I'm trading short term today is way more important than what happened 20 days ago. But when you start going out 50 and 200 days, it doesn't matter as much. That's why I don't use the EMAs, and I've found that through my learnings that the SMAs, they work just fine on longer term moving averages. That's a lot of information, but I hope you find that helpful. All right, a couple other stocks, and we'll stop here. Here is Apple. It did dip below the 20-day. It closed back above it, but that's still a little bit of a breach. Intraday, it's below its 5-day EMA in blue, so it's lost the 5-day period, holding the 20-day period. We closed below the 20-day, target 50-day, and then gap fill, FYI. And if Apple rolls over, it's going to be hard for the market too. Apple's sort of like a barometer. Here is Facebook, held the 20-day. I talked about that in February. It was a very controlled pullback, bounce, light volume pullback, rip, and now here we sit. I would still want to use a 20-day EMA as a trailing stop, something to consider. And then LOCO, we don't talk about this much. Here's Pollo Loco. I ate at one of the restaurants, if I'm not mistaken, outside of Honolulu once. It was really good food, cheap food, simple food. I thought it was very tasty. But El Pollo Loco is going south, though, it appears. Huge down move based on earnings. We're right at the previous surge from earnings back in, looks like November 1st or 2nd. Because if I actually have to go back 2 years, if I was trading El Pollo Loco, I would still want puts for earnings if I traded options and if options are available. I generally don't trade stocks if options aren't available unless it's just a super small position where I'm actually comfortable with the security going to zero and I lose all my money. But you're right back here. But here's the thing. This is why I'm bringing this in. There really isn't much more support below 12.5. The next support's all this consolidation down in the 9s. FYI, not saying it's going to get there, but this was such a slow rise. There aren't any major multi-month pause points that are clear, visually clear. The last thing is this bottom back around 9.5. And then a question on KHC, which is the Kraft Heinz company. If I zoom in and see the epic drop, this is the one that caught Buffett by surprise as well. There is no sign of a bottom. There was one little up day, there was a little spike in volume, and we rolled right over. So I see nothing that says this is a potential bottom. At the very least, I want to close above the 5-day. I might even bring the 8-day in instead of the 5-day, swap that out for an 8-day, so there's a little more time in it. We get above there, then maybe I could consider a potential trailing stop at the low of the day, and then target 20-day, target 50-day, target gap. But I'll keep an eye on this one as of right now. No bottom in sight technically. That is it. Wish you guys a great week ahead. I'll see you in the next video. Take care.